Welcome to The Explainer. So today we're doing something absolutely fascinating. We are tracking the real-world results of a massive 4-year challenge. We're going to look at exactly what happens when you take $100, drop it into 5 totally different financial avenues, lock it away for 4 years, and just see what comes out on the other side. Whether you're completely new to the whole idea of putting your money to work, or maybe you're just curious about how different assets handled the absolute roller coaster of the last few years, well, this is going to be incredibly insightful.
All right, let's just jump right into it. Here is our agenda. First, we'll set up the ground rules for the $100 challenge. Second, it's individual stocks versus index funds. Third, we tackle tangible assets with real estate and gold. Fourth, we get into the cryptocurrency wildcard. And finally, number 5, we'll bring it all together to build your ultimate investment strategy.
Okay, Section 1, the $100 challenge. Now, to really figure out which of these 5 very different investments actually make sense for you, we can't just fixate on the final dollar amount. We really need an objective scorecard to judge them fairly. So we're grading each asset on 5 basic criteria. First up, the learning curve. Basically, how much time and headache does it take to learn the ropes? Next is passive income, which is just the money the investment spits out for you while you're holding it without you having to lift a finger or sell it. Then we have tax efficiency, because hey, we all want to legally shield our profits from the tax man, right? We also absolutely have to look at risk level, meaning what are the chances you just lose your shirt? And finally, the results, the actual bottom line percentage return and dollar value after 4 years.
Moving right along, Section 2, individual stocks versus index funds.
So, this is our first major showdown. We're putting the high-risk gamble of picking a single company right up against the slow, steady approach of buying a massive basket of them. And the big takeaway here is the massive difference in both effort and risk. Look, with individual stocks, that learning curve is steep. You can't just guess. You literally have to dig into a company's nitty-gritty financials, balance sheets, cash flow statements, the whole shebang. And if that one company tanks, you risk a total loss. But on the flip side, index funds have a super low learning curve. It's a completely passive, set-it-and-forget-it investment. When you buy an index fund, like one tracking the S&P 500, you're basically buying a microscopic sliver of hundreds of the biggest companies all at once. The risk drops significantly because you are so heavily diversified across all sorts of different industries. Okay, to put this individual stock strategy to the test, 4 years ago, someone literally put on a blindfold and threw a dart at a board full of 20 different popular stocks. It landed on Samsung. So we fast forward 4 years, and yipes, that $100 investment actually dropped. Even after you factor in a tiny 10-cent dividend paid out over that time, the final total was just $67.72. That is a painful negative 32.3% return.
But you know, what's really fascinating here is the sheer hit-or-miss nature of the stock market. I mean, think about it. What if that dart had just landed an inch to the left? If it hit Apple, your $100 would be sitting at $170. Microsoft, $188. And if you got unbelievably lucky and pinned NVIDIA, you'd be looking at a staggering $980 today. But that perfectly illustrates the point. The market is just wildly unpredictable. Leaving your money up to luck or even hours of deep research can still leave you with big losses if you're putting all your eggs in one single basket.
So what happens if you skip the dartboard entirely and just buy the whole basket instead? Well, 4 years later, that $100 in a broad index fund grew to $179.57. That is a completely stress-free 79.57% gain. You didn't have to read a single boring balance sheet. Plus, index funds are incredibly tax efficient if you hold them in the right retirement accounts. It's really no wonder this simple, low-cost option is the absolute favorite for most long-term investors.
All right, on to Section 3, real estate and gold. Let's step away from paper stocks for a minute and talk about tangible assets. We're going to see how property and precious metals protect and grow your wealth in entirely different ways. First up, real estate. Now, I know what you're thinking. Buying a building with $100 is literally impossible, right? Well, actually, enter the REIT, or Real Estate Investment Trust. Think of it like a giant group project. Imagine someone collects $100 from 3,000 people. They take that massive pool of money, buy a commercial property, rent it out, and then split the rent with everyone. So you might technically own the front door, someone else owns a window, and another guy owns the bricks. It takes a little bit of learning to understand, sure, but it lets anyone invest in massive properties like shopping malls or hotels without needing a mortgage or a huge down payment.
So how did our REIT actually do over the 4 years? The final tally came to $110.52. Now here's the twist.
the actual real estate value of those commercial properties dropped over the last few years, mostly because the pandemic really did a number on office buildings and retail. But REITs have this amazing secret weapon: passive income. By law, they actually have to pass on at least 90% of their profits directly back to investors as dividends. And those steady dividend checks entirely wiped out the drop in property value, leaving us with a modest but totally positive 10.52% overall profit. Now let's compare that real estate to gold. Gold is, historically, one of the absolute oldest safe haven assets on the planet. Its entire purpose is just to act as a store of value. It protects your wealth when inflation is skyrocketing or the broader economy is taking a hit. But here's the major catch. Unlike stocks or REITs, gold generates absolutely zero passive income. It doesn't pay rent, and it certainly doesn't pay dividends. It just sits there.
The good news is getting into gold is super easy. The learning curve is basically flat. You essentially have two routes. You can buy physical gold, like bars or coins. Now that means you have to find a safe way to store it, but it does give you this unique, albeit risky, ability to discreetly transport your wealth across borders if you ever needed to. But for most of us, the much easier route is gold ETFs. These are just digital shares that track the price of gold. You can buy and sell them with a couple of clicks on your phone, and in many places you can park them in tax-free accounts, which makes them highly tax efficient.
And the final result for our gold ETF? That initial $100 turned into $140.10. That's a really solid 40.1% return over the 4 years. It's definitely not the most aggressive growth out there, but it perfectly proves the point. Gold isn't about getting rich quick, it's about steadily, reliably protecting what you already have when times get weird. Let's get into Section 4, the cryptocurrency wild card.
All right, time to completely shift gears to the most modern, exciting, and frankly, wildly volatile asset on our entire list. Crypto runs on blockchain technology, which just means there's no central government or bank controlling it. Now, the learning curve here is definitely moderate. You've got to learn how to use digital piggy banks called wallets, whether they're online or physical hardware wallets, and you absolutely need to understand tokenomics, which is basically just a fancy word for the supply and demand mechanics of a specific coin. Bitcoin, for instance, gets called digital gold a lot because its code strictly caps the total supply that can ever exist.
Now, before you jump in, it is absolutely crucial to understand the sheer amount of risk we're talking about here. The tax efficiency for crypto is notoriously poor. In a lot of countries, simply swapping one coin for another is an immediate taxable event, and good luck trying to get crypto into a tax-advantaged retirement account. Plus, the risk level is just extreme. You're dealing with dizzying price swings, a very real threat of hacks and scams, and absolutely zero regulatory safety net to bail you out if things go south.
But with immense risk comes the potential for immense reward. After 4 years, that single $100 investment in Bitcoin absolutely exploded to $652.24. Guys, that is a jaw-dropping 552% gain.
Now let's just stay grounded for a second. While those numbers look incredible, it's so important to keep some perspective. Yes, Bitcoin has been the best performing asset of the entire decade, but that kind of astronomical growth isn't a guarantee for everything in the space. Smaller crypto projects might soar overnight, but they can crash to zero just as fast. The reality is crypto is part investment and part pure speculation. It is 100% not for the faint of heart, and you need an iron stomach to handle the ride.
And finally, Section 5, your ultimate investment strategy.
So how do we actually take all of this and build a practical plan for your own money? Well, if we look back at the dramatic extremes of this whole challenge, it's pretty eye-opening. On the far left, you've got the painful 32% loss from randomly picking that individual stock. Right in the middle, you have the incredibly reliable, stress-free 79% compounding of the index fund. And way over on the right, the massive, hyper-volatile outlier of cryptocurrency. So what's the big takeaway from all this? The smartest strategy isn't about throwing darts and hoping you pick the one big winner. It's about building a solid, diversified portfolio. An incredibly effective approach for most people is to just allocate the vast majority of your money into safe, low-cost, low-effort index funds. Build that strong foundation. Then, if you want, you balance out that stability by placing much smaller, careful stakes into the other stuff. You know, a little in REITs for some passive income, a little gold for a rainy day, and maybe a tiny, tiny slice of crypto for that high-risk growth potential.
But honestly, no matter how you decide to slice up your pie, you have to remember this fundamental truth from our source material today. Time is your best friend when it comes to investing. Starting early and just letting the mathematical magic of compound interest do its thing over decades is far, far more important than stressing out trying to pick the absolute perfect asset today. I mean, as we've seen, even a small amount, like the $100 we tracked, can grow into something truly significant if you just give it enough time.
Which brings us to the end of our explainer. We've dug through the data, we've weighed out all the risks, and we've seen the actual real-world results of this 4-year challenge. So the only question left for you is, knowing everything you know right now, how are you going to allocate your first $100? I challenge you to take the scorecard we talked about, apply it to your own life and financial goals, and just start putting your money to work today. Thanks so much for joining me on this explainer, and keep learning.